Okay, so we've now finished the financial statement shells, but we don't have anything in them. So we've just got the main line items, but we're ready to start building the forecast and the engine of the model. Now, if you're just starting with this exercise and you're doing it online, you can go to the top of this exercise and you can do download starting model. Otherwise, we'd encourage you to keep going with the same file if you're doing all these sequentially, so you can knock it all out like we're doing in one long hit. And that way you can sort of experience building from scratch. Okay, so now that we've finished the financial statements, we're going to start by building the revenue and expense forecasts. Now, unlike when you're in an accounting firm and you look at revenue as invoices and accounts receivable and debtors, when you're building a financial model, you do your revenues and expenses before you think about cash flow adjustments of things like accounts receivable, debtors, creditors, inventory, etc. So it's relatively simple forecasting revenues and expenses because you assume income statement revenues and expenses equals cash flow statements, cash receipts, and cash payments. If you look at Apple, Apple during 2020, incredible numbers. They had revenue in FY20 of $274.5 billion, which was a 5% increase on its FY19 total revenue of $260 billion. Okay, so in a complex financial model, we'd actually sit there and say, okay, what do they have? They've got services, they've got laptops, they've got mobile phones, and we'd actually do that by business unit, by product, by region. But today, the reality is, no matter how complex you make revenue, the way in which it flows through the financials is similar across 99.9% of models. So we're going to be focusing on that. We're just going to do total revenue. We're going to keep it simple. Okay. Now, if you look at the assumptions so if you go to the model and you look at the assumptions section and look at the forecast in 1C, you'll see the revenue and expenses have been forecast using different approaches. Now, the way we've done the forecasts assumptions in this model is we've used just some grey shading text in column H just to indicate what forecast method we've used. Obviously, it's infinite what you can do. That's why financial modeling is so much fun. We're just demonstrating some common ones here. So for revenue, we're going to use basically an amount and growth rates approach, which means we're going to assume an amount for FY21, and then we're going to assume a growth rate of 5.5%. Now, those numbers have come from the fact that in FY20, total revenue was 274,515, and that was a 5 point, I think on my little cheat notes, that was a 5.5% increase on 2019. We're not here to debate Apple's growth or where they're going to make money. We're just putting some numbers in to show you guys how to do this. So we're going to basically assume a 5.5% increase on 2020, which gets you to the 289,613, and then we're going to just assume 5.5% going forward. So the interesting thing about the financial statement impacts of revenue is, as I said, that you just assume revenue equals cash. When you then think about things like debtors or accounts receivable, whatever you want to call it, you then model that as a separate decision process, as a separate step, which we'll do in the next exercise of this, the next step of this exercise. Okay, so to include these revenue forecasts, let's just go to the income statement and go to, the first thing we need to do is we need to unhide the period title rows 5 to 8 because we're going to be using the first period again. Now, as I've said previously, the only links between the financial statements normally should be the links between the income statement flowing into retained profits and then your cash flowing into your cash at bank. We're going to be doing a lot of cross-linking of financials in this exercise because it would take a lot longer to do this any other way. It would double the length of this course, but bear that in mind. But to start with, this formula is just going to do a normal amount and growth rates calculation. So let's go to cell J12. First of all, go to B12 and just type in revenue, the revenue heading. And then in J12, we're going to say if it's the first period, if J$7, if open brackets J$7 equals 1, so the period counter number equals 1, then comma, go to the forecast and let's choose the assumed amount, which is that 289 billion.
Yep.
Otherwise, so comma, let's just take that. Otherwise, we're going to take the prior period, which is I12. So go back to the income statement. We're going to have that weird, annoying problem again. So just take I12, get rid of the IS exclamation mark. I12 multiplied by, so
multiplied,
asterisk, multiplied by 1, open brackets, 1 plus, and go back to the forecast. And you'll see that the assumptions change from being an amount assumption to being growth rate. So as we drag this across, it's going to actually change that to being a growth rate. So you just do 1 plus J13 and then close brackets twice to close off that formula. And if you copy that across, you should end up with your revenue increasing from 289,613 to 358,780.
Perfect.
Okay, and that's our base amount we assumed increasing at 5.5%. So let's just include that in the gross margin number just by going to gross margin in 14 and doing equals J12.
Yep. And copy that across. Cool.
And you'll see our balance sheet's gone out. Why is our balance sheet gone out?
So we need to do the cash side of things.
Exactly. So our net profit after tax is now increasing. So if we go to our balance sheet now, you'll see that our retained profits will be increasing by the amount of revenue in each period because it's just going straight through. So that's increasing now. You'll see it's increasing now to 1.6 trillion, whereas our cash at bank is just sitting there at the opening balance sheet balance of 38 billion.
Mm-hmm.
So what we need to do is go to the cash flow statement and include our revenue, which we're assuming to be cash at this point in time. So if we go to the cash flow statement, note that with the detail rows, we're going to put these in column C.
Mm-hmm.
So we're going to go to C12 and we're going to put in revenue as the heading. Again, you'd normally probably link that back to the assumptions, but we're just going to put everything as text. So C12, and let's link that to the income statement, which again, you would normally do.
Mm-hmm.
You'd normally have the revenue forecast calculator on an output sheet. You'd bring them both in directly from there. And you'd have an error check in that sheet as well. But in this case, we're keeping things simple. So we'll get our revenue increasing by exactly the same amounts for cash receipts purposes as it did for NPAT purposes.
Mm-hmm.
So if we equal that,
and
copy that across, and we should feel our balance sheet slot back into place.
Perfect.
So there we go. So now we've got our revenue, NPAT, cash receipts basically equate, so our balance sheet now balances. And now our revenue forecast. Now with COGS is much more complicated in reality. So if you look at how you model, you look at a real business. Let's assume you've got, say, a chocolate bar business. You would actually have raw materials. You'd have to package that. You'd have to ship it. There'd be a whole lot of direct costs that you'd include. Now, cost of goods sold broadly is referred to as direct costs of producing the goods and services sold by a business. So the important thing about COGS is they give you a gross margin figure. Now, gross margin basically is your profitability before taking into account fixed costs, which is things like your head office, your legals, your admin, your office space, stuff like that. Your salaries of people that aren't directly related to the product sales, of manufacturing and producing the products. So the gross margin number for someone like Apple is enormous because it's such an important figure because it really reflects the real profitability of their core operational part of their business. So for that reason, you really want to relate your cost of goods sold to your revenue. Now, in real life, when you actually buy products and services, you'd say, okay, I think I'm going to sell this many phones, and Apple's made mistakes in this in the past. I think I'm going to sell this many million phones. So you would actually build them up and incur a whole lot of inventory expense, and then you'd hope you sell them, and you don't have inventory sitting on your balance sheet. Okay, now in reality, in financial modeling purposes, the main thing is that you forecast revenue, and you want to make sure that when you forecast revenue, and you change your revenue assumptions and say, let's assume a 50% increase in sales, that your COGS amount increases as well. So in real life, you buy inventory and then you sell it, and the actual cost of goods sold through the income statement is a non-cash, basically alignment of your inventory sold with your revenue. In financial modeling purposes, your cost of goods sold is driven normally by your revenue. And the two most common ways of doing it are a percentage of revenue, where you might say my cost of goods sold is 60% of revenue. The other way of doing it is doing margins and saying my margin in that case would be 40%.
Mm-hmm.
Most people in the industry that know their products well are obsessed with the margin because the higher the margin, the more profitable you are. But you do need to bear in mind that a margin is not a percentage of revenue. It's the difference between the actual cost of goods sold and your revenue as a percentage of revenue. So it's a bit fiddlier. So you'll see if you look at Apple's income statement, or their statement of operations, their total cost of sales down here is 169 billion for 2020. Now, an added complexity with Apple is that they have depreciation and amortization expense, which they allocate across their expenses. So in reality, Apple's probably allocated some of its depreciation and amortization expense to its fixed costs, and it's allocated some to its direct cost, its cost of sales. We don't know what that is. So we went through Apple's Form 10K. It's a pretty high-level document. One thing they do have is because they're an indirect cash flow statement, in their cash flow statement, they have the add back of D&A coming through. So you can use that as a guide. It's a pretty solid metric as to what D&A has been included within operating expenses and COGS. We don't know how that's been allocated to OPEX and COGS. Mm-hmm. So what we're doing for the purpose of this exercise, and this is your job as a business analyst, or as somebody analysing business, it might be your own business, but you'd have that information. But when you're analysing business, you need to make calls like this. So we're going to assume that depreciation and amortization is being completely included within the cost of goods sold on Apple's income statement. So we're going to assume last year, for example, that of that 169,559, the depreciation and amortization of 11,056 was in there. Now, when you do that, you're then able to say, okay, let's look at what would happen then if we take that 169,559, we take out that 11,056 of D&A. That gives us cost of goods sold excluding D&A of 158,503, which represents a margin of 42.3%, because that 158,503 is going to be 57.7% of it's going to be 57.7% of the total revenue of 274. Okay, so which is a margin of 42. Now, the reason we're stripping out depreciation and amortization is for financial modelling purposes. You forecast your assets independently of forecasting your COGS and your revenues and expenses. So we're going to forecast depreciation and amortization of fixed assets when we model the fixed assets part of this business. And we saw that when we looked at the income statement at the start of this. We put depreciation and amortization in between EBITDA and EBIT, and that they're important metrics to distinguish, because obviously D&A is a non-cash expense as opposed to other expenses which are actually usually cash or related to cash. So we are going to strip D&A out of COGS. So if you look back and you do that also for 2019, Apple's total cost of goods sold was 161,782. Their D&A was 12,547, which reduces their COGS to 149,235. Now, if you look at that, what margin that implies on 149 billion on sales of 260 billion, that's a 42.6% margin. So their margin basically in 2019 and 20 has been 42.6, 42.3. So what we've looked at is we've gone, okay, well, what was their average margin doing that over the last 3 years? And the average margin of cost of goods sold margin excluding D&A as a percentage of total sales was 42.4%. And that's where we've got the assumption we've included in the model as 42.4% as a margin assumption. So to include this analysis in the model, we need to put that margin assumption into the forecasts. So let's go to the income statement. Now, interesting, if you look at the financial statement impacts of cost of goods sold, you need to think about this in terms of how we model it, because cost of goods sold is quite strange looking at that without inventory. But what we're doing here is we're saying cost of goods sold, for now we're going to assume it equals cash, like an operating expense. And then when we model inventory, we'll allow for adjustments to that. So if your inventory days is terrible, you'd allow for that with adjustments to your cash flow. It wouldn't change the fact that your cost of goods sold, which is driven by your revenue, would still flow through your P&L, and the way we're modeling it will also flow through the cash flow. So here we have our cost of goods sold for 2021. If we assume that 42.4% margin, we've got 289 billion of revenues with a margin of 42.4%. That implies cost of goods sold of 166,817, which we're going to put straight into the income statement and straight into the cash flow statement. Okay, so let's go to our income statement, and in row 13, let's put cost of goods sold as the heading in column B, and then let's go to J13. We need to put a formula that multiplies. So the first thing we do is we're going to negate the formula, because we want cost of goods sold to be a negative number. And this is another important thing. On your income statement and cash flow, where you have actual inflows and outflows, so your income statement, you have revenues and expenses. Your cash flow statement, you have cash inflows and outflows, cash receipts and payments, etc. We always recommend modeling outflows or expenses as negative numbers and inflows as positive numbers. And that means you can sum your income statement and cash flow statement sections, and they will give you the net movement in profit or the movement in cash. So that's what we're going to do here. You'll notice that Form 10Ks and annual reports, they often put the numbers all as positive because that looks really pretty. If you love that, you can do it for an output presentation. But for the purposes of your core financial statements, we strongly recommend using negatives for negative numbers. We also use bracket formatting, number formatting, so you can see it clearly. You might want to use red or negatives. It's up to you. The important thing is we strongly recommend negatives from negatives, positives from positives. So that means for cost of goods sold, our formula is going to be equals negative revenue, so equals negative J12 multiplied by 1 minus the margin assumption, which is the J14 on the forecast sheet. So it's equals negative J12 multiplied by open brackets 1 minus forecast J12, close brackets. Okay, and that should give you in the first period 166,817. Okay, and it's a negative number. So let's just go down to our gross margin and do alt equals, or just do equals sum the two of those. And balance sheet's gone off.
Yep.
Why?
Need to do the cash side.
Need to do the cash side. So we've now got cost of goods sold coming through net profit after tax. That's going into, if you look at the balance sheet, that's going into our retained profits in the equity section of the balance sheet. And you can see that our retained profits at the end of the period now is only about $750 billion, whereas our cash is still sitting at way over $1 trillion, right?
Yep.
Because we haven't taken the COGS out. So let's go to the cash flow statement. And this time, cost of goods sold, unlike revenue, is a payment, so it's part of cash payments. It's a detail row, so we're going to indent it in column C again, and we're just going to go to row 15. We're going to put cost of goods sold in column C, cost of goods sold, and then we're going to go to J15, and we're just going to equate it. We're just going to equate it to the income statement cost of goods sold. And that's what I mean. We're going to assume it equals cash. And again, we are cross-pollinating our financial statements here, which is not cool. But for this exercise, we're teaching you how stuff flows through the financials, not the best way to model this. As I said, there's an example at the end of this exercise which shows you how you actually take the analysis out of the financials, then bring it in as just direct links into the financials. The cross-links between the financials, other than NPAT into retained profits, other than NPAT from the income statement into the balance sheet, retained profits, and the change in cash from the cash flow statement into cash at bank, other than those two links, you really don't want to be cross-pollinating. But we're doing it here to save time, because otherwise this course would take an extra 2 or 3 hours. Okay, so now we just need to include that cash payment in the cash payments on the cash flow statement. So go down to the cash payments row in row 19 and just equate cash payments to COGS, because that's the only cash payments we have now. And if you copy that across, our balance sheet balances again.
Perfect.
Okay, so after doing this, the change in cash held, we should have now 122,796 in a forecast for 21 at the very bottom. A change in cash held, increasing to 152,123 at the end.
Correct.
Great, and we're balancing, so we're in good shape. So we've now got revenue and cost of goods sold forecast in our model, balance sheet balances, we're in great shape. Okay, so we've now got our revenues and our cost of goods sold, getting us down to gross margin on the income statement, the balance sheet balances, because we've put it through the cash flow statement in cash receipts and cash payments, and now it's time to include operating expenditure. Okay, so operating expenditure is similar to cost of goods sold, but for the fact that it's not a direct cost. It's basically things like your sales, your SG&A, things like your office rental, lawyers, people that aren't sitting there actually pumping out the chocolate bars or the iPhones. So they're basically costs that you can probably cut back a lot easier than your cost of goods sold. And for that reason, they're broken out in a separate part of the income statement. And for financial modelling purposes, if you go to the income statement, we're going to include operating expenditure in between gross margin and EBITDA. Now, operating expenditure, you might also in between those two brackets normally include other revenues and expenses. And we're not going to do that in this exercise because they're relatively minor for Apple. But the process to add other revenues and expenses would be identical to how you'd add revenue or how we're now going to add OPEX, but they would fall in between gross margin and EBITDA. It's really a personal choice. So in this case, Apple's operating expenditure was, if we go to the Apple's income statement for 2018, 19, 20, the operating expenditure went from 30 to 34 to 38 billion or 39 billion, rounding. And we're just going to include that. Now, if you look in the financial model, we've just assumed amounts. This is called assumed amounts. So we've just gone in and assumed amounts for operating expenditure. I think what we've actually done, if you want to know the background behind our assumptions, is we just looked at the average growth rate between 2018, 19, and 20, and it was 12.2% in 19 and 20. So we're just assuming 12.2%, and we want to show you a different way of forecasting operating expenditure, so we're just doing amounts. So that 43,385 is actually a 12.2% increase on the 2020 number of 38,668.
So it's a similar mechanic to revenue, but we're just showing a different way of modelling it.
Exactly.
Cool.
I mean, you could use prices, volumes, drivers, all sorts of stuff. You could do staff numbers and salaries and wages, all types of stuff. We're just trying to show a few different approaches here. Okay, so that means for the forecast FY21 year, we are forecasting 43,385. And if you look at how that's going to flow through, other than the positioning in the financial statements, it's very similar to cost of goods sold. It comes through in between gross margin and EBITDA, and we put it through as a cash payment. The NPAT impact is offset perfectly by the cash change impact, so it flows through the financial statements basically as a reduction in profit and cash. Okay, so let's put that in. So let's go to the income statement and go to row 15, and in B15 just put operating expenditure. And then it's a really simple forecast. All we have to do in the forecast is make sure we negate the number from the assumption. So equals negative forecast J15, which is where the amount assumption is. We often build all of our models using amounts to start with, and then you layer on complexity. So it's good to sort of start with this approach to get the whole model working. And I mean, if you want to be really horrible stuff, lots of people put formulas in assumption cells, which again, we advise against
Not
doing.
often.
So let's put that in, and you should end up with your operating expenditure increasing from the 43,385 to the 68,756.
Perfect.
Let's just go into our EBITDA, earnings before interest, taxes, depreciation, amortization, and just include that. So just do a sum. So equals the sum 14 to 15. Equals sum. You can't use alt equals there, I don't think.
No.
Alt equals burns you because there's too much above it.
Perfect. So equals sum of these two items.
J14 to J15. And there goes our balance sheet because, again, net profit's now going through retained profits. Cash isn't going through cash. So let's jump across the cash flow statement and include our operating expenditure. Now, obviously, operating expenditure would in real life, you'd get sent bills and you'd have outstanding invoices at the end of the year for things like your office expense. So you'd have creditors or accounts payable. We're going to model them next. So for the purposes of getting your model up, for the purposes of modeling, you model your operating expenditure assuming expenses equals cash until you then model working capital, which we'll do in the next exercise. So let's go into row 16 and in C16 put operating expenditure. And again, we're just going to be a bit dirty with this. We're going to link that straight through to the income statement. Right. We're going to link the cash flow statement cash to the income statement. Equals negative ISJ15.
Perfect.
Copy that across, and then we just need to include it in cash payments. So with cash payments, you can just adjust that to be equals sum J15 to J16. And you'll see the balance sheet will balance after doing that.
Perfect.
Love it. So now we have our revenues and our operating. We have our revenues, cost of goods sold, and operating expenditure flowing through down to EBITDA on our income statement. And other than working capital adjustments, we have our cash receipts and cash payments in the cash flow statement. Our increase in our profit and our increase in our cash in each period are identical, increasing from 79 billion to 83 billion, from 21 to 25, and our balance sheet balances because the impact of those. Now, if you look at my screen now, you show the combined financial statement impacts of those three different revenue expense items. We have the 79,411 coming through. 79,411 coming through the income statement as net profit after tax, swimming down to NPAT into retained profits and increasing retained profits by the 79,411. And we have our change in cash held swimming up to cash, which increases assets, and our net assets, change in net assets equals our change in total equity.
Perfect.
And that now our Apple model now includes the financial statement shells, revenues, cost of goods sold, operating expenditure, and we're complete down to EBITDA. So it's now time to incorporate the working capital adjustments.